comments, and particularly because it gave me a chance to elaborate on some of the things I didn't have time to talk about. No, I think it was definitely good that you had a good-sized depreciation of one. But you had, and I'm just making up the numbers, but something like maybe twice as much as I think would have been ideal, and then it sort of went like that and came sort of back up. And so what I would have wanted to do was do more to eliminate the sort of overshooting, if you will. I mean, you definitely wanted to have a good bit of depreciation over the period, and I think it was very helpful that they were on a flexible rate that allowed that. I think part of the danger was, to the extent we have momentum built into expectations, that the amount of the depreciation sort of worsened the sense of crisis in Korean War than necessary. You're absolutely right about the export financing was going to talk about it and study a little bit, but that was another, particularly with the sales of chip-built chips and things like that. There was a lot of covering. So my impression was a huge amount of the buildup in the short-term bank debt was a result of the banks then covering, in other words, the banks gave cover to the investors in export. The banks were then covering, so that gave them a currency mismatch, which they then balanced by the foreign borrower. And I think Joe's exactly right. We need to go through in much more detail than we had time to in the study to be thinking about this. And there's some nice work that Joe's colleagues at Peterson Institute have been doing on currency mismatch and so forth. Yeah, Morris is doing the journal. One of the questions there, which I don't really know the answer to, is how much you can rely on the net. So this was the same kind of issue in the credit default swaps. How much is it safe to just sort of net them out versus looking at the individual gross exposure, and then particularly where you've got different institutions having the different exposures. I haven't really thought through, but I think it's a really important issue to be dealing with more. The KEI is an interesting case. I'm not sure that they were hugely quantitatively important, but to me it was a really disgraceful episode where a lot of the banks, is my impression, formed largely on a couple of my Korean graduate students who investigated it much more closely, that these were sold almost entirely to small businesses, where the businesses trusted the banks. And I think any of us looking at those would say, this is a sucker's game of the way that they were structured.
Can you explain what they are?
Yeah, it was, I was afraid someone would ask. See, there is a very nice table that explains them in the study, but it's roughly like you are, at the time, all of the exporters were worried about the won continuing to rise. So they were hedged, in effect, against continued rise. It was like an option, partially. But they were fully exposed if there was a fall. So So instead of just having like a forward contract that covers you for exchange risk, they were covered only for appreciation. And so when the yuan depreciated, they owed huge amounts to the banks. So it was a contract that they clearly didn't understand, because no sensible person would have entered into it at the kind of rates that my impression is that they were sold. So it was, I think, my impression is it was sort of like the small municipalities who would sit by these auction rate securities, and you're covered safe, and they were safe in a normal market, but you had big open liabilities. And so I think the courts have at least thrown some of these out as things. So I think this was one of those cases where the banks really were not behaving very well in the products. Because I say these were mainly, so there were a number of these, and most of them were fairly small. So I'm not sure quantitatively how important it was, but certainly it gave the banks a black eye, and I think in this case appropriately.
All right. Mr. Villalon?
A couple of comments and observations. Maybe I can start with the TICOs. So from my understanding, actually, they were like barrier options. So if the exchange rate appreciated within a band, it was okay. But if it appreciated too much or depreciated, then they weren't a hedge. But everybody made money. I mean, I wouldn't. Well, I mean, of course, it's graceful in many ways, but not that different from selling subprime mortgages and all this. So, if you're betting on appreciation of houses, as you were saying earlier, you're betting on appreciation of the one.
Yeah.
So the overall exposure was probably only about $4 to $5 billion. Not a big amount from from a systemic point of view, and I don't think that was the main issue when the crisis hit. Actually, it was certainly got everybody's attention early on. The other question, the other remark before I come to my question was on depreciation. Given that in Korea households and firms do not have open foreign exchange positions, you could argue that you should step away from intervening if there's a liquidity squeeze globally and money is being pulled out. A lot of this was wholesale financing that was being withdrawn. Why should you defend the exchange rate? Because who's exposed to depreciation? In fact, on the net, it seems. I mean, not that I would argue that because it's beneficial you should step away, but then be asymmetric about it. But, and then it has bounced back. So, agreed that from a confidence point of view, it was terrible because people said, "Why is Korea getting hit so hard? Something we've been struggling with for a while." But from a systemic point of view, it wasn't bad to let the exchange rate move. But as long as you let it move back the other way. When things get better. So that's, I think, just my sort of personal view on that issue. And finally, on the banks, we had this, I guess the question was, foreign versus domestic banks. I think it's important to make the distinction to foreign bank branches because their business model is about open foreign exchange positions, borrow in dollars and on lend in the KEI market or elsewhere. Domestic banks have a very strict currency position, and so when there is a big currency mismatch, it's the mismatch that the foreign bank branches that, and they were responsible for a large part of the foreign debt buildup that you see in aggregate numbers. You could argue, again, this is a regulatory issue which is being discussed, that if those foreign bank branches get into trouble, it's really their headquarters problem. It's not really the Korean banking system or the regulators' problem. So, although they are considering measures extending liquidity requirements to foreign bank branches, but I think that's the issue that will be moving forward. Because even though from a financial stability point of view, it's not a big deal. Certainly, when you have several tens of billions